So we've talked a lot about trends, and we still have so much more to talk about. There are so many more rules and tidbits and ways to identify trends and calculations, but you got the basics. Now I want to give you some general rules for using trends. Number one, the more touches you have on a trend line, the more strength it has. And that is true for any support and resistance. If you hit the same price level over and over and over and over again, that gets built into the collective mentality of all traders as an obstacle that cannot be crossed, and people adjust their strategies for that. The more times you touch a trend, the stronger the trend is. Likewise, the longer a trend lasts, the more significant it becomes. So if you are in a trend line for over a year and finally that trend breaks, there's going to be a lot of fear and sentiment if that break is to the downside, because people have grown comfortable in this uptrend, things are changing, and we've moved away from the comfortable known to the uncomfortable unknown, and prices and volatility tend to spike when you get into those situations. 3, the more aggressive a trend is, the less sustainable it becomes. If you looked at Bitcoin on its amazing skyrocket trip to 20,000 in 2018, 2019, you know that an aggressive trend cannot be sustained. The faster a price moves to the upside or the downside, the least sustainable it becomes. When you're looking at trends, if your trend line is sloping at 80 degrees, it's unlikely to be able to continue at that pace. You want a slow, sustainable trend that you can use to find support and resistances, that you can use to find ideal trade entries and exits. Number 4 is that trend lines require vigilance and adjustment. There are no hard and fast rules for trends. It was one of the first things we talked about. There's no way to know for sure 100% where a trend line is going to be or if it's going to be effective. You need to be watching your charts. You need to be constantly monitoring them and be open to the idea that you're wrong and adjust your trends in order to compensate for all new data. Number 5, levels of support and resistance are never exact, and that's even more so the truth when you're dealing with trend lines. You can have zones of support and resistance, but using the specific price levels that people often utilize in situations like equilibrium trading, where if you cross $93.31, you know things are changing. Levels of support and resistance on trends have a fuzzy area of support. Sometimes you can cross that area of support and see the wick on your candle dip below that area of support and then move right back up. You've got yourself a fuzzy area of support. And that is why using support and resistance on trend lines can be difficult. Overall, you have to remember that the trend is your friend. And people have said this. It's probably the most common phrase I've heard in trading, and it is very true. Don't bet against the market if the market's going up. The market knows where it wants to go. You might be able to capitalize on some of those counter trends, those sub trends, but overall, the market's going to move up and it's going to go there with or without you. So if the market's moving up, make sure you're trading in kind with the market. You're also going to be making bets that the market's going to go up because the trend is your friend. And I've included this picture in particular because the market is a scary beast. And even though you think it's your friend 1 minute, it can definitely rip you apart if it wants to. So we need to be prepared. We need to be vigilant. We need to adjust our charts. We need to be conscious of the fact that support and resistance levels are never exact, and we need to compensate for that fact when we make our entries and exits. All right, let's talk about some basic strategies that you can utilize trends for. The first one we're going to start with is channel trading. And channel trading is probably the most common way to make money in the market, even if you don't recognize it. Basically, you just buy at some point during an uptrend, and we want to utilize technical analysis in order to find those optimal entries. So to utilize channel trading, you have to recognize that you're in a trend. You have to have confirmed levels of resistance and support, just like we see here. Our resistance line is indicated by the blue on the upside, and then down here we have our support line. So what we're doing really is playing a game of ping pong between these two areas of support and resistance. We know that as long as we maintain this trend, we're going to stay inside this confined range. So we can use that to our benefit. And what we do is we scout for an entry near the bottom of our trend. So once we hit a bottom, 1, 2 confirmations, 3 confirmations, even if you wanted to wait for the 4th or 5th confirmation in this case, because this is an extended trend, all you have to do is wait till you're down to that area of support, make a long position. So you buy some stock here, and then if the trend is going to hold true, the price will move up, and continue to move up as long as that support holds. So it's theoretically a very easy way to make money in the market, buying an uptrend and just holding that. So to reiterate, we enter a long position at the bottom, right where our support is. We move our stop losses up as the trend develops in order to make sure that we're going to stay profitable, and we exit at the first sign of resistance. So there are a couple options in this case. We see that we have a resistance line right through the middle of our trend. We can draw that in if you want to, or you can wait until you hit your trend line resistance. Trendline resistance in this case, not very clear because we don't know that we have that resistance until we get our third confirmation. So what we're going to be doing is utilizing multiple strategies for exits. You can learn more about that in some of our other materials. But look for areas of resistance inside your pattern. We know that patterns and trends can be fractal, so there could be a trend inside this trend. We want to watch for that. And then just exit for signs of reversal. So why does channel trading really work? It works because it relies on support. We know that a trend is a trend, and the longer a trend stays in place, the more reliable it is. So when we have a support that's confirmed 4, 5, 6 times, we can bet with relative confidence that it's going to hold. So entering a long position, setting a stop loss just on the other side of that trend line support in case it does indeed fail, and then riding that support and that enthusiasm to the upside. Another reason that this works well is because there are clear levels for entry and exits. We know where our support is, we know where our resistance is, and it gives us a very easy profit target to work with. And as I mentioned before, probably the most common way for people to make money in the market is trading with the trend and using that mantra, the trend is your friend. So the next strategy we're going to talk about for trends is the break and back test. So we know that the longer a trend stays in place, the more reliable it becomes. But that also means that the longer it stays in place, the more significant the break of that trend becomes when it eventually does happen. And it will eventually happen. So when you get a break of your trend line, it is a major shift in the sentiment of the market and often has a very volatile and very aggressive response. So what we're looking for on the break and back test is the break of a trend line that we have been watching and then a back test of that level. Now I'm going to explain a little bit about that as we get going here. But to set up this trend, to set up this trading strategy, we need to have a sustained trend with recognizable areas of support and resistance. And we can see that we've got multiple touches, 1, 2, 3, 4 on our resistance line, 1, 2, 3 on our support line. So we are indeed in a nice 4-hour trend. Each of these bars represents 4 hours of trading action. And then eventually we get down here, we test this area of support, and we don't get a bounce. In fact, we fall through it, we come back underneath, and if you can make it out just barely, we come back up and hit that area again for the first test of the former support now acting as resistance. So this is the first possible entry on this trading strategy. When you break your supporting line, you fall underneath that, and you have an initial back test. That back test is going to be one of your opportunities. Now, this is a more high risk opportunity because often we can see where trend lines have the price action move below the line and then come back up and recover. So we know that we can dip into that zone of resistance. But what we're doing here is we're taking a bet based on volume and other factors that we're going to break this trend line support and it is not going to hold, and we're not going to be able to get back into that area. So first opportunity, short entry on the break of your supporting line. Your second entry is a back test of the previous level, and that is where the break and back test comes into play. Often when you break a trend line or any sort of pattern, really, if you have a defined area of support and resistance, you will see the price action dip below that. You'll see the market hesitate and want to come up and reconfirm that former support, in this case, as a new resistance line. At that point is your second conservative entry. So you get an opportunity to enter a short position on the break of your pattern. You also have another opportunity when you get these back tests. If this back test confirms this area that used to be our support is now going to be our area of resistance, we can expect further downside following that test. And in this case, we see that follow through with the price dropping considerably as time goes on. So why does it work? Well, the trend has been in place for a long time. It's important, and it shows that the market is comfortable. When the trend changes, that is a market showing us that has shifted from the known to the unknown, and the market does not like unknown and uncertainty. It represents trend change and volatility, and what we're going to be using is these old support lines and these old trend lines to our advantage by getting these breaks and back tests. So we're shifting from a known trend line to an unknown fear and capitalizing on that fear using our previous information from our patterns. So the back test is a very excellent and very, very common strategy for entering positions. Watch out for it on pretty much any sort of break, whether it's a breakout of resistance or a consolidation pattern. Look for these pullbacks and these back tests. They can be very profitable for you, and it's a very, very easy trading strategy for utilizing trends.